Important. Mark it as important. Very good problem. Mark it as important. Please. Page number 92, question number 37. Now, with this I leave you. Please don't talk, so that we can start with the futures in the next class. Please. Already 45 minutes behind. I wanted to have a futures introduction. Not possible. Only let's try to complete this question number 37. Please. From the following data, calculate the price of a call option expiring after 1 year. Spot rate $1 50 rupees. Strike price $1 60 rupees. Risk-free rate 10% per annum in India, 15% per annum in US or for dollars. Expected range, maximum minimum spot on maturity of option after 1 year is rupees 70 and rupees 40. They did not use the word 2, it is 70 and 40 per dollar. These are all the details given. Please. Range also should not have been used, but okay, it is maximum 40 of 70, minimum is what? 40. These two prices can be taken. Now, once you read the question like this, immediately what model? It's a binomial. Normally binomial is solved using risk neutralization method, is much more simpler. Everybody yes or no? No. So always we use risk neutralization for binomial, yes or no? No. First is very rare, we leave that. Always the problem is about risk neutralization. Can you start doing it or not? No. Let's start writing the facts. Right? Facts. Tell me question number 37. Okay, page number 92. Okay, please. Facts. Spot price. $1 is equal to how much rupees? Rupees 50. Spot price $1 is equal to rupees 50. Next is what? Strike price. $1 is equal to how much rupees? 60. $1 is equal to rupees 60. Third is what? Third is what? Interest rate. What is the interest rate in India, in US? Tell me how much in India? 10%. US is 15. Very rare. India is having a low interest rate. 10%, 15%. Given the question here, okay, can I put it now? Now, term of the option. What is the term of the option? 1 year. Term of the option is 1 year. Now, FSP can be either what? 70 or 40. These are all the details. One should go for the value of this. This is a what option? Call option. Option is call option. We have been asked to value the call option. It is not Black-Scholes. We have only two prices. It is a binomial model which we calculate using the risk neutralization method. That's what always we should be adopting. Can I start or not? No. First, how many steps are there in binomial? Tell me. 3 steps. Step number 1 is what? Risk neutral probability. Step 2 is what? Future value of call and put. Step 3 is what? Present value of call and put. In this problem I had only value call option, no need to value the put option. Okay, but these are the 3 steps in what? The risk neutralization model. The first step is what? Risk neutral probability, which you can do in 2 methods. Table method, formula method. Let us do under both. Can we start or not? No, please. Please. Now don't disturb. Very important sum. This will lead us to a concept next class in futures where dividends are annualized percentage. Okay, please. A very important sum. Can I proceed? Now, please. Write down step 1. Do along with me. Step 1 is what? Risk neutral probability. Step 1 is risk neutral probability. Risk neutral probability. Columns situation. Next is what? FSP. Probability, expected FSP. Situation, FSP, probability, expected FSP. Situation 1, situation 2. Write always first what? Upper. What is the FSP? Upper FSP? 70. And downward FSP how much here? 40. probability P. Probability 1 minus P. What is the expected F as P? 70P. 40 into 1 minus P. If I total, I get 70P plus 40 minus 40P. Up to this, everybody, yes or no? This expected FSP should be equated to future value or spot price. What future value or spot price? Yes or no? We compound the spot price to future and then equate it in stamp on it, did or not? No. Tell me, future value or spot price. Now, what is spot price? 50. This 50 should be compounded at 10% or 15%. 10% or 15%. I should use both IRPT. Everybody will follow what I am saying. Because here the dollar also earns me what? Interest. In what I am saying. So, future value spot price is nothing but forward. Nothing but what? Forward. What forward? IRPT forward. Everybody will follow what I am saying. This is uniqueness in currency option valuation. This is going to have the effect in Black-Scholes and other models also. Please tell me, are you following? No. So when I equate the expected FSP is what? The forward rate calculated as per what? The IRPT. No. So can I proceed further? Now continue. Write down. IRPT forward rate. IRPT forward rate. Because don't make a mistake of compounding 50 rupees alone, because dollar also is capable of getting compounded, because both are money. Both are what? The money. It's not a share. It's not what I'm saying. In the category use what forward? IRPT forward. Can I proceed? Now, tell me, what is spot? $1 is equal to rupees 50. After 1 year, after 1 year, I am doing derivatives, normal IRPT. The chapter, I'm doing option value. I'm doing option valuation, so no, I'm doing a derivative problem or not. Now, in that case, when I do compounding, I use normal, continuous. Continuous. Following what I'm saying or not. So, use what compounding? Continuous. Now, in that case. I'm born doing it. Can I say now? $1 into e power. Dollar is having how much interest rate? 15%. 1 year, it is always per annum. E power 0.15 is equal to, please, is equal to, continue, rupees 50. Spot price 50, yes, rupees 50 into e power 0.10. Respond, are you following what I am saying? So, $1 into e power 0.15 is a future value of dollar, future value of what? Rupees. Can I proceed, please? What's happening here? You have to copy, Please, stop. No disturbance. Have you all finished copying? Please write quickly. Now, IRPT forward calculating. $1 is equal to 50 rupees spot. Written or not? Now, after 1 year, dollar compounds at 15% e compounding and rupee compounds at 10% e compounding. $1 is equal to e power 0.15 is equal to 50 into e power 0.10. Finish copying or not? Now, please, can I proceed? Now, please. Shh. We'll simplify it. $1 is equal to 50 rupees into e power 0.10 divided by e power 0.15. Innappa, yes or no? 50 rupees into e power 0.10 into e power 0.15. Can I proceed? Now, simplify it. $1 is equal to 50 rupees into e power 0.10 minus 0.15. Yes or no? X squared by x cube means what? X power 2 minus 3. We have a common base or not? No. Please. Shh. Like that, I think you are all following what I am saying. E power 0.10 minus 0.5 is equal to 50 rupees into e power minus 0.05. That means I have to compound and discount the discount. Really have to go for what? Discounting. Which is equal to, please, 50 rupees into 1 by 1 point. Tell me, 0, 5, 1, 2, 1, 3. 1, 3. 50 rupees into 1 by 1.0513. Stop talking, please. Which is equal to 47.56. 47.56. Now, today the rupee is 50. You know, rupee is what? 50. The expected price of the rupee after 1 year. The expected price of the rupee what? After 1 year is how much here? 47.65. Why the asset value decreases in future? Because rupee earns only 10%. Dollar earns what? 15%. You know what I'm saying? In that case, the dollar is what? Weakening because of what? High interest rate. Respond. Are you following what I'm saying? That is why it is as per the IRPT, the dollar should be quoting at what? Discount only because of its high interest rate. Yes or no? Otherwise, covered interest arbitrage will come into picture. No. So now, this is a expected FSP or not? Now, what I should do is, I should equate the 70p plus 40 minus 40p to what? This 47.56. In a clarity, now, continue writing. 70p plus 70 plus what? Plus 40 minus what? 40p is equal to 47.56. That means 30p is equal to 7.56. What the probability? Probability is equal to how much? 0.252. 1 minus p is equal to 0.748. 1 minus p is equal to 0.748. This is the probability of the price. Risk neutral. Risk neutral. Nobody can calculate probability. It's called as what? Risk neutral probability. Respond yes or no? No. Please tell me. No. Next. This can be calculated alternatively using the formula. Right or not? No. Right on. Next. Please. Alternative. The formula is, what is the normal probability formula? P is equal to e power TRF minus D divided by U minus D. Yes or no? Now, see here one small change. E power T RH minus RFC. RH means return on home currency. RFC means what? Return on foreign currency. I don't use the word RF, you make it confused, risk-free, hence I wrote as what? RFC. Okay. E power T RH minus RFC minus D divided by U minus D. Right along with me? Probability is equal to E power T RH minus RFC minus D divided by U minus D. Minus D divided by U minus D. Please tell me yes or no? No. In this problem, first U is equal to what? Upper FSP divided by spot. Upper FSP divided by spot. FSP எப்படியே வரும்? அது spot price. Upper FSP divided by spot. What upper FSP? 70 divided by 50. Please, concentration. What is the number? 1.4. U is equal to 1.4. D is equal to downward FSP divided by spot. Please, divided by spot. What is downward FSP? 40 divided by 50 is equal to 0.80. Now, please do along with me. Don't be ahead. Don't create confusion. Can I proceed? Please. P is equal to E power T is what? 1 year into 0.10. What is the home currency interest rate? 10%. Minus what? 0.15. What is the foreign currency interest rate? Minus what is D we have? 0.80 divided by what is U? 1.4 minus 0.8. 1.4 minus 0.8. Everybody understood or not? Now, please tell me. We have found out here 1 by 1.0513. The simple even tell me what the number here. It is P is equal to 0.9512. E power minus 0.05 is 1 by 1.0513 we had. You got us what number? 0.9512 minus what is D? 0.80 divided by what is U? 1.4 minus 0.8. 1.4 minus 0.8. Tell me what is the number here? 0.252. Yes, 0.252. 1 minus P is equal to what? 0.748. 1 minus P is equal to 0.748. 0.748. Everybody understanding it or not? No. See, please. Let's understand the logic of what is being discussed. Remaining 2 steps can be done in 5 minutes. Okay, please. Then only last step I can also make you understand it. Listen carefully. This discussion will be applied later. Always don't discount any discussion I am making. All are important ones. All this which I discuss now, if you don't listen, confusion may come during exam. Now, please. Understand our logic behind the risk neutral probability calculation. See, take this as a share. Take this as what? A share. Okay. A share is trading today at 50 rupees. How much rupees? Yeah, 50 rupees. It can be 70. It can be what? 40. Take an example. Okay. Now, what we said is, a risk neutral person do not want any premium for the risk taken. Then he will be expecting a share price at the end of the first year or not? Today's share price and expected share price, the growth will give you an amount that should give him a risk-free return. He wants to earn the risk-free return through what? The growth in the share price. Now, for that, he assigns what? A probability. That probability we call what? The risk-neutral probability. So, the risk-neutral probability will make the future spot price, expected future spot price as a number. That number and today's spot price, the growth rate is what? The risk-free rate. With the probability, when I find out the value of the call and put in the next stage, I will be getting an expected value of the call and put, which a risk-free person will be expecting. Yes or no? Which a discounted what? Risk-free rate. Logic has been much more elaborated, discussed. Now, come to this. This person also is a risk neutral person. What person is? Risk neutral person. He wants to know a probability of a risk neutral person who wants to earn what? A risk free rate. How much rate a risk rate you want to earn here? 10% he wants to earn. He wants to earn this 10% by growth in the dollar value. Today he buys a dollar at 50 rupees. Take continuous leave it here. He wants to make it as what? 55. He wants to make it as what? 55. Yes or no? Today dollar 50 will goes to what? 55. He is said to be earning a risk rate of 10%. That means if this is a share, the expected FSP should be equal to 55. I should find a risk neutral probability. But I did not equate to 55 if you see. I equated it only to, how much rupees here? That is 47.56. The question is, sir, I want to earn a risk-free return. 50 become what? 40.76. What is happening? Yes or no? Because I don't want to have a loss here. I want to have what? A risk-free return. Why you want the share price to become what? 47.5. The question arises now. See, in this case, he is not only earning a return from growth in the dollar value, the dollar also gives him an income by of interest. See, dollar, he has invested 50 rupees in dollar or not. He wants to earn 10% return. He wants to earn how much percent return? 10% return. Suppose dollar is an idle asset. Nobody gives interest. I put a dollar in what account? Current account. No interest. That means for me to earn 10% return from this dollar, the dollar should be how much rupees? 55. So I bought at 50 and sold at what? 55. 5 rupees profit for me, 10% return. Yes or no? But no, I don't want that 55 rupees because when I buy this dollar today at 50 rupees, I don't only depend on the appreciation in dollar to earn income. The dollar itself gives me what? An income of 15%. I want a return of 10%. The dollar is giving me what? 15%. That means how much return I want? Minus 5%. I am willing to even go for a discounted price. Are you following? Issue no. So this is not happening in case of what? A share. It can happen. It has happened. I'll discuss it later. Yes or no? So there's an underlying asset and a risk neutral person wants to earn a risk-free return from the underlying asset. For that, he is going to set up a probability. If he wants to earn a risk-free return from the underlying asset, we just said in all the previous sum that he earns it through the growth in share price. He earns through what? Growth in share price. Same way here also, he has invested in $1 today 50. He wants to earn a risk return of how much percent? 10%. And if there is no interest given by the dollar, then the FSP should be how much? Yeah, 55. From that, I have to find out risk neutral probability. Yes or no? But I found out the probability not using 55 but only what? 47. Why? Question arises now. Don't worry. I require 10% return from the dollar, but dollar is giving me what? 15% return. I am not dependent on the price appreciation. Even the price can what? Depreciate to 47.76. So very simple. When I buy a dollar today at 50 and I sell tomorrow at expected how much? 47.56, and in between receive what? 15% income. Net amount I am earning is how much? 10% risk return. For the setup what? Probability. Risk neutral probability. Respond yes or no? Same thing has happened for share also. How the dollar gives you interest, the share gave you dividend. In that case, dividend amount given, what we did? We adjusted against what? Spot price and then compounded. The entire spot price need not grow up by what? 10%. Spot price minus what? Dividend. That amount is enough to go to what? 10%. Is what is the logic given. Everybody yes or no. So share can declare dividend like that. The currency can declare what? Interest also. We adjusted the interest against the required rate and balance has been compounded. Now, so tell me why e power TRF. We had no e power TRF. Why it is not e power TRF alone? Because I want what return? That is home currency, 10%. On my investment, I want how much? 10%. But the underlying asset gives me how much? 15%. I want the 10, asset gives me how much? 15%. That means the return I want from the asset price growth is only how much? Minus 5%. So it is going to be less than 50 is a logic for this discussion. Yes or no? So whenever underlying asset generates income, generates what? Income, I generalize it. Income can be given in rupees or in percentage. In dividend, they gave you 5 rupees dividend in 6 months. Now what you will do? Discount the 5 rupees, adjust against what? Spot price, call as revised spot price, did it? Yes or no? In land valuation also, the underlying asset land gave me what? Rent. I discounted what? Rent. And then the net land, I did not compound 12 lakhs land to 15 lakhs. I compound only what? 11.008 something to what? The future, because I don't want the return on 12 lakhs. I want return only on what? 11 lakhs or not, because already asset gave me 1 lakh. What I am saying? In that case, what is happening is, when the underlying asset generates income, knock off the income, the balance only you should expect as what? Income from the growth in price. Everybody follow what I am saying? That is why RHS has been reduced from what? RRC for my calculation. No. And this has been completed. So let's complete the problem. What is the probability? 0.242 for upper bound and 0.748 for what? Lower bound. Can you quickly complete that? Now tell me step 2. Everybody, what is step 2? Future value of call. I'm going to find out the future value of call. Please, all of you, future value of call option. Future value of call. Tell me the columns. What are the columns? Situation. So the first column situation. Next is what? FSP. Third is what? Value of call. Fourth is what? Probability. Last is what? Expected value of call. Situation 1, 2. FSP can be 70 or 40. 70 and 40. I have a strike price how much here? How much is it? 60. Strike price is what? 60. Tell me, I have a right to buy at 60. A dollar worth what? 70. Exercise or lapse? Exercise. What the value again? 10. I have a right to buy at 60. Yes, say dollar worth what? 40. Exercise or lapse? Lapse. Value is what? 0. What the probability of 10? 0.252. What probability of the downward? 0.748. Expected value is 2.520. So the expected value of call after 1 year is how much here? 2.52. 2.52. This is the benefit or value of the call after 1 year. Can I proceed? Now, I want expected value, today value or today value. Can I proceed to the next sheet or not? Everybody copying along with me here? Now, step 3. Present value of call option. Present value of call option. Present value of call is equal to, what expected value? 2.52. Now, I should discount that 10% or 15% or both. Only 10% because both will be taken when both sides generates income. Yes or no? Now, this is the value of a dollar option. Dollar can give you interest. Yeah, option dollar cannot give you interest. Do you understand what I am saying? Now, This is not the value of a dollar. It's not value of a dollar. See, in this case, $1 is equal to 15. The 50 rupees is what? Value of a dollar. 50 also can give you interest. Dollar also can give me what? Interest. Yes or no? Now, in this case, this is a value which I get from a dollar. Call on a dollar. Dollar can give you 15% interest. A call option cannot give you what? Interest. So it is simply an option price. So an option is what? How much rupees? 2.52. This is rupees, dollar, rupees. I should discount rupees, rupee rate, dollar rate, rupee rate. Discount straight away. So no, 2.52 into e power what? Minus 0.10. 2.52 into e power minus 0.10 is equal to 2.52 into 1 by 1.10. 52 or 53 here? 52. So what is the number here? 2.28. This is the worth of a call option. What is the call option word? 2.28. Value of the call is 2.28. Everybody, are you understanding it or not? No. That's one or two more issues to be discussed in this regard. I'll discuss and give you some notes in the next class and start with the futures. Okay.